Hi, and welcome to another episode of Facts, Figures, and Fallacies from the Front Line. Today, we're very excited to have Jeff Sicking joining the podcast. Jeff is a mortgage loan officer with American National Bank and Trust with over 20 years of mortgage lending experience. He specializes in investment property financing and custom home new construction. He also helps handle standard home purchasing and refinancing as well. Jeff is involved in the community, so he has a lot of great insights. He even teaches some financial education locally in the Decatur community. And outside of work, Jeff enjoys real estate investing, traveling with friends and family, and supporting his kids at sporting events. So that's Jeff's background there. Jeff, how are you doing today?
Man, doing great. Excited to join you guys.
Awesome. So some of the questions that we wanted to ask you today, just to give you those here at the beginning, we wanted to talk about the key factors that currently are driving changes in residential mortgage rates.
Okay.
So that's one item. Another item was how should home buyers approach rate fluctuations when deciding the right time to buy or refinance a home?
hmm
And then also what trends or predictions that you see over the next 6 to 12 months. So
Okay.
those are kind of the high level things we wanted to make sure we discuss today. But
Okay.
anyway, I'll turn it over to you, Jeff. Thanks for joining us, and we're
Yeah.
super excited.
No, yeah, thank you guys. I geek out on this stuff, so y'all keep me from getting too in the weeds. But no, I do teach a little speak to a real estate group every Monday morning, and I really enjoy that because it keeps me on my toes trying to prep for that to know exactly what's going on in the market every week, what those financial data releases are that will affect mortgage rates. So we're extremely try to stay extremely current on exactly what's going on and have our finger on what's going to affect that rates this week, this month, this year, this next couple years even, so that we can give accurate and valuable counsel to our prospective buyers and folks looking to refinance or whatever the case may be. So, yeah, just a lay of the land as far as where we are today. We're sitting in a what I'll call high six to right at 7.0 mark on a conventional 30-year fixed rate mortgage. The government market is actually a little more favorable right now. Right now, our what we call govies, VA, FHA, and USDA, all three of those government type loans are actually in the lower sixes, 6 to like 6.25 typically for a
Hmm.
30-year fixed on those products.
So,
Um,
Jeff, has that come down since, say, January?
it's been, kind of doing, a little ebb and flow up and down, Mitzi, but not significantly. We've eased down a little since basically last October, but have been, in a fairly tight range the most of this, last quarter and a half. We've had conventional rates as high as 7.25 for a minute, and as low as 6.75. Govy rates is in the dipped into the high fives for a minute and maybe have been as high as 6.375, 6.5. But for the most part, we've been in this same spot we're at today for most of this year with a little bit of a downtick early in 2025.
Okay.
But it seems like we're in one of those modes where we've been talking about the Fed is going to do these significant rate drops for years now. We're thinking it's coming the next quarter, and then the can gets kicked to the next quarter. And we understand that it's all data dependent, but it seems like that can just continues to get kicked quarter by quarter down the road, which can be a little frustrating for us in the industry, and especially for buyers trying to buy, because we would obviously love some relief, now, ideally, So
Jeff, have you seen, so say year over year, we're in July,
mhm.
this July versus last July, are we up or are we down as far as writing residential mortgages?
As far as volume or rates, you would say
Volume.
volume. I would say we're probably up 20 to 30% from this point
Really?
last year. Yes, ma'am.
Okay.
And so I would lump into that. purchases in new construction. But yeah, I think it would be safe to say on an average month, we're probably writing 20% more than we did this time last year.
So that's a positive.
It is. It is.
And what factor is the most important factor that we need to look at to know when those rates will come down? And let me ask you this first.
Mhm.
Do you feel like we need to get back down to a 3 or 4% mortgage to get started writing mortgages again? Or do you think people just need to get used to this 6 and 7%?
I'm afraid it's either the latter or somewhere in the middle. I mean, I feel like, if you look at long-term mortgage rates back from, over the last, say, 50 years, we're probably pretty close to that average rate right now, because you've got to factor in all those Carter years of hyperinflation, with the post GFC, super, super low rates. I mean, we're kind of in that average realm right now. We've just been so spoiled for the last 20
Yeah.
years, or 15 years, to have just extremely low, lower than normal rates. We've all kind of grown accustomed to that and would expect that. In my opinion, the odds of us getting a conventional loan rate into the 3 or 4% range is extremely low. I don't know that it's realistic to think that we're going to see that anytime, soon, barring some extremely unexpected, crisis of some sort, a World War III type breakout, or a GFC type, Great Depression, repeat, type. I mean, when I say extreme, I'm not talking about a recession for a quarter or two. I'm talking, a huge shock to the market. I think barring something like that, I don't think we're going to see a 3 or 4% 30-year fixed rate mortgage in the foreseeable future, in my opinion. And with a lot of the buyers that I talk to, there's certain folks that are comfortable right now with the high 6, low 7 conventional rate. There's a lot of folks that have said, you know what, we're not quite comfortable with that payment that rate yields. Maybe let's look at it in 6 months or a year and see where things are. I feel like there's a lot of folks that are on the fence right now that would be comfortable if we could get, even close to a point in relief, to where, everything that we're looking at today, if it was, conventional rate, not very high 5s to low 6s, I feel like that would be a really good happy median, a good balanced level for the markets, as far as a rate that folks are comfortable with, that would spur a significant amount of activity, I think, but not a level such that, the COVID era did, that caused, hyperinflation in the housing market and all those kinds of issues. And,
So what would it take to drop just 1%?
I mean, I think if you look at a lot of the so-called experts' projections, I think a lot of those guys, if you said, hey, where's the market going to be a year and a half from now, say end of the year 26, a lot of folks are predicting a 6.0-ish range for the 30-year conventional loan. So I do think that would. I do think that's realistic. I do want to just mention really quick. People pay so much attention to the Fed. It's coincidentally, they're meeting today, not expected to do anything as far as a rate drop or anything. But I do think it's important to point out that even as they will, hopefully start doing their incremental quarter point drop in the Fed funds rates, that's not necessarily going to exactly equivalent to a quarter point drop in mortgage rates. It could, but more than likely, a lot of the, call it 2 quarters this year and maybe a couple quarters next year, a lot of that's already kind of priced into what we're seeing today. So we need some positive longer term guidance out there to really push these mortgage rates down. Just a couple of quarter point Fed funds rate drops, I don't know are gonna help that a whole lot.
So what would it look like if Trump came out, say in September or October, and said, hey, I've got a new Fed chair for you. This is the man, and he's going to drop to 1%. Would that?
I think that definitely would help, because that would, if you dropped, 200 basis points off the Fed funds rates, that's significantly more than what's baked into the cake today, if that makes sense.
Mhm.
So that shock to the good side on the markets would definitely I think, cause a noticeable immediate impact in mortgage rates in the 10-year treasury, that track very close to that.
And
The
the
other,
immediate, would that be, we would see that September, October, or we would see
I-
Q1, Q2,
so
26?
the good thing about mortgage rates is they react to market data immediately. I mean, if you watch the 10-year treasury, which is going to almost perfectly track to the mortgage rates, it'll literally, move within milliseconds of a data release, coming out and hitting the market. When you see a CPI number hit high or low, you're going to immediately see that 10-year treasury go up or down. Mortgage rates are a little harder to track because there's not a fixed index like the 10-year, but they're going to track exactly in line with that, with their certain risk premium built in above that. But it'll track tick for tack with that 10-year. So basically, it would not be, my point is, Mitzi, it wouldn't happen when it goes into effect. It would happen on the data release. So when Trump announces that and the market says, hey, this is going to happen, this is not just pie in the sky, this is legitimate, this is going to happen in a month, 3, 6 months, whatever, I think you would immediately see mortgages price that in. The other thing that I don't think people talk about much, they all talk about the Fed funds rates, which doesn't have much to do with mortgage rates, from a correlation standpoint, is the quantitative tightening side of things. I don't want to geek out too much on this, but the Federal Reserve purchased literally billions and billions of dollars, almost trillions of dollars in mortgage-backed securities and long-term treasuries to push long-term rates down during the COVID pandemic. So they've swelled their balance sheet immensely. And so what they started doing when they started tightening rates, when inflation became a concern a couple of years ago, is they basically started to not just not buy those securities anymore, but they started to let them, taper off as they matured and amortized out. So essentially, they're shrinking their balance sheet, which what that does is it causes less buyer demand, in the market, which is going to naturally cause the prices of these securities to go down, which causes rates to go up. So, the thing that this administration, in my opinion, could kind of maybe would, if they would look at, is, to put a halt to those actions, because those would act that, if they were to continue to swell that balance sheet a little bit, it would definitely push mortgage rates down, just because of that additional demand for those securities, if that makes sense.
Right. So we could have quantitative easing, or we could have a Fed rate cut. What is it that really moves the mortgage-backed securities rate?
I would say right now, the biggest factors that we've seen move the mortgage rate hands down over the last 2 years has been inflation data. The mortgage rate and the 10-year treasury track almost identically, like we were saying earlier. And the biggest, I think, risk that most investors in those securities see is inflation risk. So as the PCE, inflation gauge, or the CPI inflation gauge comes out, that has been a huge market mover. More recently, I would say the trade talks have almost taken over as a primary driver, especially when it first started, before we realized there was a lot of, strategic negotiating going on, and maybe not to take things at their literal face value. We had some huge shocks in the rate market when the trade, war first started. And now I think the market's finally realized, hey, this is a negotiating tactic. We're not going to end up with a, 100% tariff on everything or whatever. But, to answer your question, I would say the two biggest drivers right now are both inflationary, the CPI, PCE index releases on inflation, as well as the trade talks.
So if you had like some kind of major market event and the market had a significant decrease, people shifted into the bonds, would that drop the mortgage rates as well?
Absolutely. I mean, any time we have what I call a risk off event, where there's something, I hate to put it this way, but anytime there's something bad that happens in the world financially, that's generally a good thing for mortgages and for mortgage rates, because when good things are happening, people don't go buy, secure mortgages and secure long-term treasuries. They're taking risks. They're in the stock market. So the opposite's true when something crazy happens, and everybody's a little bit freaked out, frankly. Their natural inclination, as far as when I say the market's natural inclination in those risk-off times when everybody's a little panicked, is to sell whatever risky assets they've got and go put them in more secure assets, which would inarguably be, the 10-year bond and mortgages.
Right. So we could have some kind of a major market event. We could have maybe some super high inflation, or maybe some kind of crazy Trump, signal that he's replacing the Fed chair, something like that.
Yep. I think definitely, depending upon the, how hawkish or dovish, the new Fed chair is going to be. I think there's no doubt it's going to be a more dovish chair. But, there's no doubt that when that appointment's solidified, that will definitely move the markets.
You say it looks like we just need to get used to a 6-7% interest rate, but any of those three significant events could cause those rates to come down. And just with the way things are going, what do you think the likelihood of one of those three things triggering a lower rate would be?
I think the most likely is, obviously the Fed chair. We know there's a May deadline on that, obviously, and something's going to happen well before then. So it's guaranteed that's going to happen. And I think there's no doubt that there's going to be a dovish appointment there, whether it's, the Treasury Secretary or whoever the other top contenders are. I think any and all would be more dovish than the current administration. The other thing I want to point out, though, even if you have a dovish Fed chair, they have one vote out of 12 on the board, so you could have the most dovish chair in the world pushing for all kinds of things, but you've got 11, if you had 11 hawks, nothing's going to happen,
Right.
So I think people maybe put a little too much emphasis on the chair when it's an actual board that truly makes those decisions.
So maybe if he came out with that in September, October, 1%, maybe it would drop by 1% or 0.5%.
In the mortgage world, 1% is pretty significant. I would say, 1/4 to 1/2 would be my educated guess as far as what could be expected. There's also the flip side of that coin, Mitzi, that there's a little bit of that already priced into the market today. The market knows there's going to be a new Fed chair. The market knows that that this administration wants a dovish chair. So the flip side of that coin is some of that may be already priced into what we're seeing today. I do think the trade talks, as they continue to wind down and settle down, could help some as we see those impacts, especially as we see the tariffs go into place and inflation not skyrocket.
Right.
I think there's definitely, we continue to get positive or flat inflation readings. That's extremely positive for the markets, because at the end of the day, that's all everybody cares about is, hey, is inflation going to pick back up and eat into my bond return if I go buy a bond or a treasury bond or a mortgage?
Right. So the more stability we have in the market, really the higher rates are going to stay, right?
Yes, ma'am. I would definitely agree with that.
So probably it sounds like, from what, in summary, it sounds like we just have to get used to these rates. Maybe we'll see 0.5%. And what do you think for the foreseeable future, 1 year, 2 year?
I would say just my blind guess, crystal ball here. I don't want to be negative or anything, but I struggle to see rates, more than 100 bips lower than they are now. I really do. Just there's a lot of good things happening in the economy, which is great. That's good for our country. It's good for business folks. It's good for consumers. It's good for everybody. But all of that good is bad for rates.
Right.
So I hate to put it that way. But at the end of the day, there's a lot of good things going on out there as far as, the future of what the economy is going to look like the next couple quarters or years.
Right. So you said that year over year, you're up 20% on mortgages. Is that including refinances?
I really don't put refis into that. I do lump construction loans, which technically most of those custom home construction perm mortgages are a refi. I look at those
Mhm.
more as a purchase because you're building or buying a new home.
Right.
Our refis, just being very frank with you, we're very low. I mean, it's probably 10 to 20% of what we do. And I can't think of the last time we did what we call a rate term refi, which is a refi with the sole goal of lowering the interest rate. You just don't see those very often right now because we don't see many people with a 8, 9, 10% rate, which is what it would take to justify a refi.
Right.
We are occasionally doing some cash outs where folks may want to pull some equity out of their home to do something else, pay off debt, go buy land to build on later. We are seeing a lot of that right now. I would say refinances are probably relatively flat,
Right.
with the majority of those being cash outs to do something else.
Right.
with
So if
that
you want
equity.
the equity out, probably now is as good a time as the next year or so.
It is. And I'll tell you, in the old days, the previous 2 decades of my business, mortgage business experience, if we wanted to do a cash out, we would do a new first lien. So we'd pay off your current first lien with a new first lien. You just have that one larger consolidated mortgage at the end. We do very few of those right now. A lot of folks that come to us that have a lot of equity in their house might have a 2, 3, 4% first lien currently. So we don't want to pay that loan off at a 6 or
Right.
7% rate. So a lot of times what we're doing, when I say we're doing a refi, we're not technically refining the primary first mortgage. We're leaving it in place to preserve that rock bottom rate, way below market rate, but we're stacking a second mortgage on top to pull that equity out to go do whatever we need.
Almost like
So,
a HELOC.
yeah, it is. It's very similar to a HELOC, except a HELOC is kind of like a big revolving adjustable line of credit. We'll typically do what we call a closed-end second, which is a loan that doesn't fluctuate up and down in balance. It's a fixed balance, and you pay it down every month, just like you do your primary loan. But most importantly, unlike a HELOC, that rate's going to be fixed for a certain amount of time. Whereas the
Mhm.
HELOCs are typically, not all, but the majority of them are a true ARM, in that they adjust with the current market rates every quarter, or 6 months or a year.
And your second lien, those are 30-year or 15-year?
It
Or
depends
either?
on the product. Most of the second liens we're doing are a shorter term because they're typically a smaller loan. It's pretty uncommon for us to do a $400,000 or $500,000 second. Most of those are 100, 200,000, somewhere around there. Typically, Mitzi, those are going to be in the 15 to 20-year AM range. We'll even do some 10 years.
But they're fixed rate.
Most of the smaller, shorter term ones, we will put on a permanent fixed rate. Some of the larger, 15 to 20-year loan amounts, we will have to put like a 5 or a 7-year adjuster on there.
Mhm.
In full disclosure there, the thought process or rationale behind that is, this isn't a loan we're able to securitize on the secondary market where that we pass the interest rate risk on to investors. This is something we're keeping on the books in our bank as a portfolio loan. So essentially, the risk there is, rates go up and we've got a ton of super low fixed rate loans on our books that gets extremely risky for our balance sheet. So to hedge that, we may put like a 5 or a 7-year adjuster on there.
Right.
That is a little better than what you're going to see most folks get on a second, though. Most of them are purely, adjustable rate loans or maybe a 10-year fixed.
Well, Jeff, do you want to tell us a little bit about your business that you're working, your company that you're working
Sure.
for right now?
Sure, absolutely. No, we're so excited with all the things we've got going on. My team and I joined American National about 2 years ago, and we had previously been with a similar community bank for about 20 years, and had gone through some acquisitions and mergers and just a lot of what I'll call corporate stuff that got to the point where it kind of tied our hands on being able to take care of our customers. It's kind of what led us to make the decision to move to American National, is just being with the more nimble local community bank with the ability to do a lot of things we've talked about, the seconds, lot financing, construction financing, stuff like that. We have local decision making. So if I have a loan that I think's a good fit for the bank and for the customer and makes sense, We don't have a lengthy, cumbersome loan committee and process to go through to get that approved. I literally pick up the phone, make one phone call. My boss and I spend 5 minutes looking through the deal and seeing if it's something that we can do or not. And we have an answer immediately.
Nice.
So that local decision making is just extremely valuable in our industry. A lot of folks just don't have that comfort.
Are you still all residential?
We currently, as far as our Decatur operations, are solely residential. We do have branches pretty much scattered all around here that have commercial ops. Our Denton guys will step in and help with commercial projects around here, and they literally will come meet with folks in our office and have done so in the last quarter or two when commercial projects and needs arise. So we've also got a branch in Roanoke and Fort Worth, and those guys have helped on commercial deals occasionally too. At some point we'll have a commercial lender in this location. That's probably a couple years down the road if I was to just guess. But
okay. But you can write commercial loans.
Absolutely.
Through your company. Mm-hmm.
Absolutely. And probably the most exciting thing that's happened, I'm under the mortgage department, so this doesn't really directly apply to the hat I wear. But in the last month, we have added deposit operations, essentially full banking deposit op services here to the Decatur location downtown. So we have an on-site teller, Linda Evans, who has decades upon decades of experience in that realm and does a great job taking care of her customers, is extremely hands-on. And, if you want a banker that you can get a hold of and call the question, she's your girl.
Good.
So excited to have that new addition here recently.
Okay. And where can people contact you? What's your email?
Sure. So my email is just jeff.sicking@amnac.com. That's just jeff.sicking. It's SICKING, and that's at amnat, AMNAT.com.
Perfect. Okay. Well, we'll include that in the description as well.
Okay. Thank you, guys.
Okay. Well, thank you for coming on with us. Nick, do you have anything else?
Yeah, maybe one closing question I thought
Sure.
maybe would be interesting. What advice would you give someone like me, for example, who I actually got my first mortgage through that COVID period where the rates were like, 2.8%. So what advice would you give someone like me that has a really low rate and it looks like the future that's not going to be the case? Is it good probably to just try to stay in this house, pay it off, and wait until that point
Sure.
to think about moving, or what are your thoughts on that?
Man, I mean, I have a lot of conversations with folks like, you or folks in that almost identical situation every day that, may have outgrown their house or for whatever personal need, ideally want something a little different than where they are. But you're right, Nick. It's extremely difficult to sell your house, pay off that 2 or 3% note, and go buy something else at a 6-7% rate. So I guess, long story short, my advice is you are in such a great position. It's tough to give that up. The only thing that kind of thinking outside the box here, conversations I've had with some folks, is if you are the entrepreneurial type and are in a home that you think may have a good rental market or potential income stream, there would be nothing to keep you from moving out of your house, converting it to an investment property, and then going and purchasing something else. We do have a couple of folks that have done that over the last few years. And the beauty is that you get to keep that rate that you currently have, even though it converts to an investment property. The lenders, generally write notes such that that note required you to live there for a reasonable amount of time once you bought the house, but it doesn't say you can't move out of it in a couple of years and convert it to a rental. So I think that's a great way to preserve that rate, especially if you can pick up a great positive cash flow on the property that would allow you to more comfortably purchase something else. So that's a conversation we could have. That seems to work, but long story short, it is very difficult to pay off a house to sell a house, pay off an extremely low sub-market rate and go finance something in today's world,
Yeah. One more question related to that.
Yeah.
Those loans are not assumable, correct?
So generally speaking, most conventional loans are not assumable. Some of your government loans will be. That
Would that be like an FHA?
Yes, those typically will be assumable, and they're qualifying assumable, meaning you would need to call the current servicer who you're making your payments to, or the assumer, or the one wanting to buy the house and assume the note, would need to call the current servicer to actually qualify per the FHA guidelines to assume that loan.
So they may be willing to pay more to assume that lower rate.
Absolutely, they definitely should be able to. I mean, the biggest kicker, I guess the two biggest kickers we've seen in assumptions, we don't deal with those directly, but we've tried to help some folks navigate a few of those situations. One, you're not dealing with a mortgage professional on the retail side like me or somebody from my staff or any other local or whatever retail loan officer. You're dealing with somebody in a service department. They're generally not going to be as customer service oriented, and not as motivated to make sure that you get your loan closed within a month or two or whatever. So that's a little bit of a challenge. The other thing is that to keep in mind, just an example here, but say Nick's selling his house and somebody's going to assume his note, say he owes 200 on it, but he's going to sell the house for 400. They've got to cover that $200,000 in equity essentially.
And they can't get a second for that.
So they may be able to get a second, and we've looked at helping folks with situations like that. But the point is that first mortgage that's 200, that's fixed. They can't bump that loan up to fund the new value or the new price. You're stuck with that balance and then having to pay Nick his equity some other way.
Good. Well, good to know.
Sure.
Well, Jeff, thanks for joining us. This was
guys,
super interesting information. So again, anyone watching this, if you're looking for a mortgage lender, definitely get with Jeff. He's great. And we really appreciate you joining us today.
Yeah, I enjoyed it, guys. Y'all have a good one, and look forward to next time.
Yes, thank you.